The spreadsheet has been open on your monitor for 11 straight hours and your eyes are starting to burn. Imagine working at a quiet regional investment firm in Oslo, managing $4.2 billion while remaining completely invisible to the rest of the world. Tonight, your task is to stress test the fixed income portfolio against a massive 150 basis point interest rate shock. This is the 48th time you have run this exact simulation, but something feels fundamentally broken this time. At precisely 11:48 p.m., the entire model collapses and refuses to hold. The error isn't yours. A senior manager named Eriksson has intentionally bypassed a critical duration constraint. He buried a $340 million leveraged exposure to long-dated Norwegian currency debt inside a cell formatted to look like a simple zero. The swaps were based on the impossible idea that volatility would stay flat forever, making the entire hedge completely decorative and useless. Then the central bank shocks the market with an aggressive rate hike announcement, and your paper losses explode to $61 million instantly. You don't sleep at all that night. Instead, you build a second and then a third independent model to confirm the disaster, and they all point to the same catastrophic end. At 2:15 in the morning, you compose an encrypted message to the compliance officer and press send before you can find a reason to stop. By 7 o'clock the next morning, the report has already reached the board of directors. By noon, external auditors are swarming the building asking for documents that no one was prepared to show. Eriksson is immediately placed on administrative leave while the rest of the floor avoids making eye contact with anyone. The firm eventually closes the position with a loss of $47 million because the market shifted slightly in your favor. In the aftermath, the only thing the leadership remembers is that you were the one who found the needle in the haystack at 2:15 in the morning. 3 weeks pass. Eriksson is officially gone, and life seems to return to a dull normal until your phone rings. The man on the line is Hawan Vesteras, a heavy hitter who works for the Government Petroleum Fund. This fund manages $1.4 trillion and owns roughly 1.5% of every publicly listed company on the entire planet. He tells you there is an opening in quantitative risk and suggests you think about it over the weekend as if it were a casual conversation. That casual tone tells you everything you need to know about the scale of his world. You start your new life on a Monday in January with a new badge that simply reads Analyst Quantitative Risk. For the first 8 months, you do exactly what is expected by building factor models and decomposing portfolio variance. You notice that $800 million decisions are discussed with the same casual tone as choosing where to go for lunch. The numbers don't feel real yet, and $1 billion sounds like someone else's problem to solve. What changes your perspective first isn't the sheer size of the fund, but its incredible patience. This massive entity doesn't react to quarterly earnings misses or analyst downgrades, it simply holds its ground. The fund is so large that if it ever decided to panic sell, it would move the entire global market, so panic was structurally removed from the equation. You're beginning to understand how this massive machine works, learning the secrets of genuine capital permanence. By the 3rd year, your title changes and you are finally allowed into the room where the big allocations are decided. You aren't sitting at the main table yet, but you see that decisions are reached through politics and history rather than just textbook formulas. The head of equity is a formidable woman named Pi Latti who controls $620 billion with absolute intellectual rigor. She once killed a $2.1 billion infrastructure deal in 40 seconds because she remembered the failure of a specific consultant from 2019. You decide to start building your own private archive, documenting every deal and every risk model the institution has ever used. If you want to learn how to navigate these high-level financial waters and master your own portfolio, make sure to join our community at Billy Finance for more deep dives into the world of elite wealth management. By year 5, you have risen to the rank of portfolio strategist, managing a $74 billion sleeve of real assets. You are no longer just trading. You are acquiring structural positions in things like Chilean water systems and Kenyan renewable energy. You expected to feel powerful, but instead, you feel a heavy sense of permanent obligation to the millions of people your decisions affect. When a Chilean consortium raises water prices, you are the one who has to model the reputational and regulatory risks of that choice. You recommend a $14 million community investment program not out of idealism, but as a calculated move for risk management. Every position you hold affects someone's life, even if they will never know your name. By the time year 8 arrives, the call doesn't come from inside the office, but directly from the ministry. The minister offers you the position of Deputy Chief Investment Officer, and you accept knowing that your days of restful sleep are officially over. You work under a legendary figure named Thorvald, studying his patterns and blind spots as if he were a complex spreadsheet. You learn that at this extreme level, capital moves through deep relationships rather than through public markets. You find yourself across from global bank executives, restructuring $90 billion in capital while demanding board observer rights. $1 billion has become a standard unit of measure for you, and the scale has finally stopped feeling abstract. As year 8 closes, Thorvald reveals that he is stepping down and gives you 18 months of notice. The list of external candidates is long, but you watch it get crossed out name by name until only you remain. The confirmation of your new role comes in a 4-minute call from the minister. You are now the chief investment officer, controlling more capital than the total gross domestic product of most nations on Earth. You're only 41 years old, and you realize that true power doesn't arrive as freedom, but as a narrowing of what is possible. When you stop making public appearances, that absence begins to serve as its own signal. You learn to tell the difference between careful deliberation and total paralysis. From the inside, they feel exactly the same. The very network that helped you reach the position of chief investment officer starts to shrink the moment you actually take the job. It is the same process every time. The number of people who can speak to you with complete honesty drops to fewer than 20. Eventually, that number will get even smaller. You sign off on a $2.2 billion allocation without a single moment of hesitation. $1 billion is no longer a massive sum. It has simply become a single unit of measurement. The markets start to push back, and amber warning lights appear on your dashboard. But you do not panic. Every move you make is being watched by the ministry, by your competitors, and by markets that have already factored you into the price. The chair you sit in does not make you permanent. It only makes you visible. Those are two very different things. Your marriage has become a matter of logistics and shared calendars. You both understand this, even if neither of you ever says it out loud. The illusion that you actually control the market begins to take hold. Then the market inevitably corrects that mistake. You finally learn that the market does not care who is sitting in that chair. It never did. The first year as chief investment officer closes without a catastrophe. In this line of work, that alone is a significant achievement. Then comes year 2. A country within the group of 20 enters a sovereign debt crisis. They are illiquid but not yet insolvent. The market has already priced in a full default. The International Monetary Fund rescue package is still 12 weeks away from being approved. You have $18 billion in dry powder from a rebalancing your predecessor endorsed with great reluctance. That rebalancing was approved 6 months ago, and those $18 billion have remained undeployed. Nobody felt comfortable with the situation. You run the scenario for 4 straight days. Every model you have says the exact same thing. The country is just lacking liquidity. It is not bankrupt. That distinction is worth $6.2 billion. You begin to buy sovereign bonds that the market has already written off as worthless. You deploy $2.1 billion in the first tranche. Over 11 trading days, you move a total of $6.2 billion across 3 quiet installments. It is not enough to rescue the country on its own, but it is enough to signal that permanent capital sees value where the market sees only ruin. Other institutional buyers start to follow your lead. You said absolutely nothing. The position you took said everything for you. The International Monetary Fund package is eventually finalized on much better terms. The country does not default on its debts. The yields begin to reverse their course. The position is marked to market at a gain of $1.1 billion in unrealized profits. 14 months pass without a public statement or a single press release. To acknowledge the success would mean acknowledging just how much you moved the market. The mandatory disclosure filing eventually triggers a legal review from the Ministry Council. This was expected and handled within the official mandate, but a parliamentary review is still required. The word technically is doing all of the work in this situation. The review is structural in nature, not punitive. The real question is whether the existing rules are still adequate for a fund of this scale. The legal opinion finally arrives. The intervention was within the mandate, but a parliamentary review is still necessary. The next person to hold this office will operate under a much narrower set of rules. You made that change permanent by demonstrating your edge and showing what was truly possible. In doing so, you made it permanently less possible for anyone else to do the same. That is the ultimate reckoning. The second year comes to a close. The investment position holds firm. The review begins, and the rules of the game start to change. You read the legal opinion on a quiet Tuesday evening. A parliamentary review that is structural, not punitive. You set the document down. The markets in Tokyo will open in just 4 hours. The world does not pause to wait for you. The fund manages $1.4 trillion. There are 9,228 companies across 73 countries. Every single one of them will open for business tomorrow. The liquidity framework assumes that no single event will ever require selling off 4 different asset classes at the same time. That assumption has held true for 19 years. You are not certain it will hold true forever. The quantitative team flags a breakdown in correlations within the real asset sector in 2017. The pattern reminds you of something from long ago. A simple spreadsheet, a late night in a quiet office, a much smaller life. The scale changed everything except for the fundamental nature of risk. That stayed exactly the same. You open a new analysis window on your screen. You start building a model the way you always have. Somewhere in the levels below you, a junior analyst is running a stress test that will not be resolved until the morning. You do not know her name yet. She does not know you exist in any real sense. The fund will outlast both of you. It was here long before either of you arrived. The capital is permanent. The people are just temporary. That is the one rule that never changes. The correlation flag is still open on your monitor. The model remains incomplete and unresolved until the morning sun. Somewhere in the world right now, another crisis is already starting to form. You will not see it coming. Somewhere below you in this very building, another operator is already rising. It is the same process all over again. You are powerful, but you are never safe. The parliamentary review opens in 3 weeks. The game does not end. Every resolution simply opens up the next problem, always. Tomorrow the markets will open. They are indifferent to everything you have built. They are as patient as geology, waiting to show you what you still do not know. Tomorrow you will sit back down and begin again. Thank you for watching this story of power and global capital. Make sure to subscribe to Billy Finance for more deep dives into the world of high-stakes finance. Please leave a comment below with your thoughts on the weight of such responsibility. Goodbye for now, and see you in the next one.